not thrilled with how the textbook covered some of the stuff on financial statements because it was like super, super basic, right? And, if you have one product, here's how you compute a break-even statement. So we're going to go into the real details on this. Starting off with financial statements. So if you haven't done a lot with Excel, you will today. So accounting, and probably you know some of this, but some of it will just be a review and some of it will probably be new. Accounting is just recording and classifying financial transactions. So essentially, it's just capturing where the money goes. The money that came in, the money went out. So financing, on the other hand, is raising money to fund your startup and operating costs. So one is tracking where the money goes, and the other one is getting money, and not from your sales, but getting money from whoever you can convince to give it to you. And the break-even point is the point at which expenses equal revenue. So that's where you finally have stopped losing money. Now, I suppose in theory, it could be the point where you quit making money, but that's not ever how it goes. So there's three types of statements you're really going to need. One is your cash flow analysis, what they call statement of cash flows. And we've talked about that a lot. You've done it yourself. If you have a bank account, if you have a checking account, if you have a savings account, basically that's what you're doing. You have the money that you had at the beginning of the month, the money that came in, the money that went out, and the money that you have left. So that's pretty easy to keep track of. And if you look at your bank statement, there you got it. Assuming that you deposit the money in your bank account and assuming that you have a separate bank account for your business, which I highly, 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 highly recommend. I think it's a big mistake if you don't, for a bunch of reasons. One is it makes it super easy for taxes at the end of the year. The other is it's very easy to see if you're losing money or making money, because it's very easy to track your cash flow if you just have a separate business account. So an income statement, which we're going to cover in great detail in a minute, is your revenue, subtract from that your expenses, and you get your net income. So the examples they had in your textbook were really, really basic, right? You have food and beverage sales, which magically you just got and added up all your sales somehow. You have the cost of goods sold. In expenses, you'll have two types of expenses that we'll cover in a sec. You'll have fixed costs and you'll have variable costs. So your income statement, you have revenue minus expenses equals income. Now, the difference between cash flow and income is the income statement shows all of your expenses and revenues. So, and both of those are important. You need to have both. So if I sold $300,000 to Microsoft this month, it counts as revenue because I had a sale of $300,000, even if they didn't pay me yet, because that revenue, that sale to them is an asset. So, and a lot of times it happens that your cash flow and your revenue are not going to match up exactly. So with a lot of these bigger companies, they have a 60 or 90-day net. And if I'm selling to a big company, there's not a darn thing I can do about it. You know, we had a contract with a company that's one of the top 50 companies in the country, probably in the world based on size. And they said, we pay 90 days, that's it. So, I mean, there's nothing we could really do about it. It's basically you take the contract under those terms or you don't get it. And so in that case, I basically have an IOU from whatever this company is saying they will pay me $300,000. So there's where I have revenue coming in, but it's not showing up in my cash flow. The other thing that happens is with depreciation. For example, if I have a truck that costs $50,000 that's going to last 5 years, it's going to depreciate at $10,000 a year. And so my cash flow is going to look great right up until that 5th year when I no longer have a truck and I need to come up with $50,000. So in that case, I have a cost of $10,000 a year in how much my truck is depreciating in value, even though I'm not paying that out in cash. So if you don't track that, your business looks really good right up to that 5th year when you can't replace your food truck and you're out of business. So you want to track both of those because, yeah, it's great if I have $300,000 in sales to Microsoft. And I have been in this position before where, yeah, I have that revenue. I have a contract saying this company will pay me. But if I have no cash, how am I going to pay my employees? They're supposed to be doing the work. So unless I can finance those expenses until I get the cash, I'm going to be out of business. And this is the crazy thing where sometimes you'll see companies where it looks like they're doing great on paper, that they've got all of these sales, but then they go out of business. And it's because sometimes your sales go up before you actually get the payment in, and yet somehow you have to send that stuff out, you have to deliver it. So, like I said, even if I have $300,000 in sales, if I don't have the cash flow to pay people, then I go out of business. And that has happened to people. They're growing so fast that they end up broke. And on the flip side, this has happened to me too. I not only have $5,000 in the bank, but I just signed a contract with USDA for $1 million. So I'm in pretty good shape because I have $1 million coming in, even if I only have $5,000 in cash. And there's a reason that I used both Microsoft and USDA as examples, because it's highly unlikely that they're going to go out of business, right? When we talk about assets, your accounts receivable, basically the IOUs that you have from people, those are an asset if they're from somebody reliable. I mean, if I had, nothing personal, Anna, but if I had something from Anna saying, I will buy $1 million worth of games from you, I'm not sure that the bank would lend me money against that. So both of those things matter because the difference between your cash flow and income statement you can either be doing better or worse than it looks like when just looking at cash. Now we're going to go through some really basics from your textbook, and then we're going to go through for real, because this is why I used to say that I would never hire anybody right out of graduate school, because they didn't know how to do anything. You know, they could, like in statistics, they could prove the central limit theorem, but you know what? Some Greek guy did that way back when, so I don't need that done for me. You know, what I need is somebody to be able to program a computer, or in this case, your text gives really basic stuff. So we're going to go over really basic stuff. And then we're going to do a real, here's how I would figure out how much money the Sync store is going to make and how much money I need to get financed. So the very basics, I mean, they're correct. Okay. Your margin, also called your gross margin or contribution margin, is how much you make from each item, each sale. So if you're selling pizzas and they're $12 and it costs you $4 for the ingredients, then your margin on each one is $8. So it's basically the sales price for whatever it is minus the cost of that thing. You're going to have two types of costs, fixed cost and variable cost. Now, it's not exactly that way because some things kind of overlap, but basically fixed cost stays the same regardless of how much you sell. You know, your mortgage on a building is a fixed cost. You pay that mortgage every month, and if you don't sell anything or you sell $10 million of whatever, you're still paying the same mortgage. Now, in rare cases with rent, like at a shopping mall, it might be your, $600 a month plus so much per square foot. But generally, it's not. Generally, your rent, your mortgage, your utilities, stuff like that is a fixed cost. If you bought a truck, right? The depreciation on that truck is a fixed cost. If it's going to last for 5 years, then every month for the next 5 years, 1/60 is that cost is depreciated, regardless if you sell anything or not. The variable costs vary with how much you sell. So, inventory is an example of that. If the cost of goods sold. So we're not going to go through a whole accounting class, but we're going to go through a few things that are important. So if I'm selling soda and baked goods and stuff like that, the more soda, the more baked goods, the more pencils I sell, the more the cost of those things I sold, because I had to buy each one first and sell it. So there's variable cost and fixed cost. Your textbook gives a super, super simple way of computing your break even. And the idea is to give you, the point is to give you the idea, right? And it's a nice example if you only sell one thing. So if all you sold were pizzas and you have total fixed cost of $2,000 a month, that your rent on all your ovens, let's just say that your restaurant, you bought it turnkey, pay me $2,000 a month, and that covers the cost of the ovens and the rent and everything like that, and utilities included. Then if my break-even cost on every pizza is $8, I say, all right, I'm making $8 on a pizza. I have to come up with $2,000 a month. So I divide 2,000 by 8, and I need to sell 250 pizzas. That's my break-even point. So that's the concept. But of course, in real life, most people aren't just selling one product or service. Now, maybe some people are, but like Anna, you were talking about doing some kind of consulting company, right? And would you charge like a fixed rate per hour? Or would you charge more for certain things?
It would be for certain things. So like, for instance, you can only charge $15 per notary, right? But you can charge a travel fee, and that's where the change happens. So by mileage. But normally it's like $400 for loan docs.
Yeah, when I started a very long time ago, I charged $50 an hour for consulting, and I charged $75 an hour if I had to leave town. If I had to leave my house, it was $75 an hour. And a lot of times then at that point, people would decide, plus expenses. And people laugh when I say this, but it's true. If you were an ass, it was $1,000 a day for putting up with you. And there were people who would pay, I mean, I didn't specifically write that in the contract, but there were people that they were so obnoxious, I charged them $1,000 a day because that was the cost of putting up with them, and they would pay it because they couldn't get other people to work for them because they were like that. So you may have a sliding scale. And I did tell people, it's 50, and this, like I said, this was years ago when I got started, but I said it's $50 an hour. But if I have to come to you, it's $75 an hour. And that $75 starts when I leave my house and ends when I come back. I mean, I don't charge them, if I'm asleep, but 20, if it takes me 8 hours to get to wherever you are, because I have to change planes and take a car and all, you're paying me. So anyway, it would be nice if everything was like this. So you start out, this is the amount I have to make for fixed costs. This is the amount I'm making on each thing. This is my break-even point. So that's a nice example. So we're going to start with doing it for reals in a sec. Basics of finance. So that's the basics of accounting. I hope you enjoyed that because it gets more complicated from here. So basics of finance, how much is it going to cost you to start your business? How much money do you have? And how much money will you lose in the months until you break even? And this last part is the one that a lot of people forget about. Like they think, okay, it's going to cost me $10,000 to start out, but they don't think about the fact I'm going to lose $5,000 the first month and $2,000 the second month and $1,000 the third month. And if they don't have enough money to cover that, then they're going to go out of business. So start with how much it's going to cost to start, subtract how much money you already have, then add in how much money you're going to lose in the first few months until you break even, or the first few years. And that gives you the amount you need to raise. So with the Sync store, and there's a good reason for doing these finances, and that is that it makes you look at what your assumptions are that you, and it helps you kind of let what it is that you need to do. So for the Sync store, I'm going to say we need computers that we're going to track our inventory on and that cashiers can use. And I looked it up online, and you can buy the software for point of sale software to track it. So I think you need two, because what if one breaks down, right? Or we're gonna have two cashiers, maybe we could have one that's doing inventory while one is helping customers. We'll have two customers at once. So regardless, you need two. You'll need a printer and other peripheral things. There's, if you're printing out receipts, which people probably want, there's a little, I don't know what you call it, but there's a tiny little printer thing that prints receipts. You need cables, all that kind of stuff. Shelves, we'll need to buy some shelves, put in there to put our stuff on. Because I'm not a jerk, I think that you need a desk for the person to stand at and take your money and so forth. You need a chair for them. And then to start with, we need some initial inventory. And I'm saying we're going to sell food and we're also going to sell supplies. The reason the inventory for food is smaller is obviously if we're going to have baked goods and stuff like that, it doesn't keep that long. So we're not going to get a huge amount at the beginning. And then as we sell stuff, we'll bring in some more. For supplies, stuff like paper and pencils and, in artwork, obviously that's not going to go bad. So we might buy more of that at the beginning. And also, and again, this goes into assumptions. I think if you go into a store and yes.
When you're talking about inventory, I just thought about something. So when we decide, well, for the store, like who do we use? Like, who do we go to, or just as in general, like who's going to bring us sandwiches, the chips, like what other store are we going to use to get us our inventory is what I'm
Well,
asking.
my preference for,
I mean, is it a business owner? Is it your own preference, or is it like a group preference, or?
well, it depends on the business, right? So if it's a sole proprietorship, then it's just whoever you decide.
Right.
If it's a partnership, it might be the partners agree, or it might be one partner handles that and the other partner does stuff like finance and marketing and that. If it's a big corporation, then they have a company. I would say for us that we would have a manager and we would maybe have an advisory board that if it was me, I would include a student, at least one student on the advisory board, and at least one person from the community, and at least one person from the faculty or staff. Now, my proposal for buying things is that we would be, if we're talking about community, and that's one of the things we're marketing, I would very, very heavily favor local people. So like if Sierra's going to open her fry bread manufacturing, I would buy from her.
Right.
If Jacob has a food truck and he's willing to, sell some stuff to us, I would buy from him.
Okay, yeah, I'm just wondering that when I
So
start
wouldn't
the
that,
proposal.
wouldn't that just create a department for like a procurement of sorts, like so that you would just have someone to manage your inventory or intake for goods and for the month or the quarter of your finances?
Well, I mean, when we get to the budget, you will see we do not have money for a department of procurement, but we will have a manager. So that
Okay,
person will
but-
have to figure it out.
But that's what it entails though, correct?
Yes, and
Okay.
actually a cool thing, SYNC is part of a consortium of colleges to buy things. So, if one little college goes out and buys pencils, we don't get a very big discount, but we're part of this, but basically a buyer's club or co-op thing. So I would buy the stuff, stuff that we can't buy locally, like pens, pencils, I buy it through them because then we get a discount. Because say we buy stuff, College of the Desert buys stuff, Riverside Community College, I don't know who all these colleges are, but so this vendor is getting not an order of 300 pencils from us, but an order for 300,000 pencils from the consortium. So we get a break on that. So my idea would be I'd go through them for the things that we can't source locally, but for the things we can source locally, I would do that.
Will you use somebody's business license?
Well, we would have a business license, right?
Yeah.
Yeah, that's a good point. I don't know what it costs to get a business license in Palm Springs. I think it's super cheap in Santa Monica. It's like, I think if you make under a certain amount, it's maybe $50 or something. 70 for us, I think it's $75 a year plus a percent of what we make, but it's not very expensive. And the Spirit Lake Nation, I think a business license, I should remember, I just paid mine. I think it's $500 a year. But then I know some places where it's just outrageously crazy.
So for that question that you just said about the business license, so
Pardon?
since it's a student store, it wouldn't go under the manager's name, right? It would go under the schools.
Right. And I think since it's a student store, it would be part of Sync, which is a nonprofit. So that's even better for us. So so startup costs, when you put down your startup costs, try to think of everything because it goes back to that idea of cash flow and figuring out what you need. If you left something off there, like I was thinking possibly, later we would want to do like a cappuccino machine or something like that. But the reason I didn't put that in there is because you need to also think about regulations. Like I know that if you sell food that you prepared yourself, then there's a whole host of health regulations. Make sure you put everything you're going to have as a startup cost. And then operating costs. Generally, employee salaries are the biggest cost. Now, that's not always true, but I think for a lot of things, it is. I know for restaurants, it's usually the biggest cost. That's why when you go to a restaurant, they give you these huge servings because it doesn't cost that much extra to give you more rice and beans, right? But it costs extra to hire another person. So things not to forget, not just employee salaries, but you have to pay Social Security. You have to pay workers' comp. You have to pay payroll taxes. You have to, because it is the law in the state of California, give your employees sick leave. So figure in, sometimes your employees will be sick. You can't just assume that if you're paying for 40 hours a week, that that's all you need to pay. Because if you want to keep your store open and somebody's sick, you need to pay that person for their 8 hours and a second person to be in the store. So, and then depending on your company, what you're going to do, you also may have to pay health insurance. If your company has a retirement fund, like a 401k or something like that, there may be rules about who is entitled to be in it. Employee salaries, do not forget this tax part, the taxes in that, because first of all, the IRS will come after you and the state of California will come after you and you will end up in trouble. So, and then rent, I'm assuming that we will get free rent. We'll see. That they will just let us use a building and we will say it's an educational experience and our entrepreneurship students can do modeling or whatever. Marketing students can come in and create marketing. So I'm going to try and talk them into free rent. Inventory, definitely not free. And marketing costs, don't forget that, because how are people going to know your store exists?
Marketing costs.
With the workman's comp, would the store need its own? Because it's gonna be like not really standalone, like,
Well, whether Sync pays it or not,
right?
generally your workers' comp is based on the number of employees you have and the tasks that they do, right? So if you, and it's also based on your record. So if you've had employees getting injured on the job at your company, your workers' comp insurance is going to go up. If your company is coal mining as opposed to software development, your workers' comp is going to go up. With us, actually, when we first started, because we had no history, right? We paid a fairly high workers' comp premium, but then they refunded us a lot at the end of the year. So you do have to pay it, and whether we pay it to, whether we reimburse the college or not, it will go up. It's very small. It's a very small amount for the kind of thing we're doing.
I have a quick question, but isn't this also like if when we drafted up the contracts, like isn't this something that we negotiate for staffing as well? Like we could just outsource what we need and have that facilitate to our business, but it's just limited to a capacity that we hire somebody at. Like,
You could hire somebody as an independent contractor versus an employee, but that's defined in the law. You can't just say, I couldn't go in and tell Roger Griffin tomorrow he's an independent contractor. That would be a really good way for me to be in trouble, because to be an independent contractor, there's the person you can't require them to be in your place at a specific place, overseeing them. If they're like for me, if I'm doing consulting as an independent contractor, I can be doing it in my house. I could be doing it at 10 a.m. I could be doing it at 10 p.m. It may say in there that I will come out to your place of employment at specific times,
Mhm.
but
That's what I was gonna say, but you would still expect them to facilitate an expectation of them to be hitting a deadline or services required or fulfillment at a given time, like if it's weekly or monthly. Um, would that really not work?
I can tell you right now that you can't say your cashier in the store is an independent contractor. The IRS will not go for it.
Oh, okay.
Because you're telling them when they have to come to work, they have to be at work at your place of business. They have to be at work specific hours. They
But
have to do specific
said
tasks.
delivery though,
Pardon?
on delivery, that's the thing. That's what I guess I'm getting at.
Like you could have somebody who has a delivery service and you pay them for fee for service. You could do that. And that person could be an independent contractor.
Okay.
But what we're talking about a cashier in a store, absolutely not.
Yeah,
will not
not
fly.
a 9 to 5 employee.
Right, right. So there are specific IRS rules for saying who is and who is not an independent contractor. And you can get in trouble for violating those because people do, because they try to basically put the onus of paying the payroll taxes and social security on the employee and not pay workers' comp. And yeah, and besides which, if they really are your employee, then you should do it. Didn't you read that chapter on ethics?
No, it's not that. It's just
Oh, you didn't, huh?
that's what you were getting at earlier for when we were in class like 2 weeks ago. Like, well, that's why we sent out the contract for it.
Right.
It's their right to work, but it's not our, like, it's a specific need that we're having met for our business.
If you're having them do a specific thing, like you contract with somebody to go and take your food truck and be at one specific event, then
Mhm.
that might fly as an independent contractor. But yeah, with what we're doing, no. I have stayed out of white collar prison up to this point in my life, and I intend to keep that track record.
Let's push that threshold just a little.
All right, so for our store and for any business, I mean, I'm using the Sink store as an example, but who are you going to hire? Are they all going to be people in the same job classification? When I started, it was just me. And then eventually I hired an accountant, and then eventually I hired an assistant, and then eventually I hired more people. So who are you going to hire? What are the job duties going to be? So these are the things you decide, and you'll go back and forth, right? When you're doing a financial statement. So what we're going to do is go through these decisions, and then we're going to create our projections for how much our store is going to make. So who are you going to hire? How many hours is person going to work per month? How much you're going to pay them? I think it's a big mistake to underpay people, to pay. I strongly believe that most of the time you get what you pay for. And if you pay somebody way below market rate and they're willing to work for that, there's got to be a reason. Now, I have made cases where I did pay below market rate, but we made really big concessions to get good people. Well, one thing is maybe if you don't speak English, right? You may have a green card and you're here legally, but you have a right to work in US, but you don't speak English. It's a lot harder to get a job. But I speak Spanish, so I don't care. And you can come work for me.
I have one more question.
Yeah.
What regarding the store again, with security. So since it's a school, do we have to put in a small amount to put in like a pool for security to pay their salary, or?
We have a deal with College of the Desert where as long as it's during
Business hours?
regular hours, they don't charge us. So we would have, yeah, that's something we would have to negotiate with them, because my plan was to have it open 9:30 to 9:30. Because I figured people might stop out and get stuff outside of, outside the regulars. One of the reasons I said 9:30 is I thought the people working there, like the cashiers,
Right.
maybe they wouldn't want to be leaving at 10 or 11 o'clock at night, even though there is a security guard here till midnight, I think. So I
Oh,
don't think they charge us extra as long as we're not outside their regular hours. Like if we had something on Saturday when they're not normally here, we would get charged. But yes, those are good. That's a good question because those are things we need to negotiate. And I like your thing because you want every single cost because you don't want at the end of the,
Well, I'm just speaking for everybody else too, because like if he had any of their food trucks, do they put in a amount because it's an event? It's not just gonna be their food truck every time, maybe, so.
And that was kind of the other thing that I had a question for was that seasonal workers.
mhm.
Um, hiring someone for 6 months out of the year or maybe a less duration than that. Now that again is contracted for either isn't that through like a working visa? And
Well, you mean if they don't live here?
if
If they're
they're
not
in
a
the country
citizen.
just for a temporary period of time through a work visa.
I haven't well, there's multiple kinds of visas. I've hired people who were on student visas when I was at a university because you can do that.
Mhm.
An H-1B visa, you have to sponsor. And so I haven't done that. And a lot of companies I don't just because I think it's expensive and you only get so many of them. I just know friends of mine at bigger companies when they were looking for employees have said, oh, I need a software developer and this or that, but we're out of H-1B visas and it's already April. So I don't know very much about that. I just know that they're a pain to get and do, and I haven't done them.
Hmm.
I also
Okay.
know that I think there's other kinds of work visas, but the most common one for technical, like H-1B is for like special skills. And yeah, I have not done, I have written letters of support for people who have gotten them before, but I'm sure it's not a simple task and it's not guaranteed.
And that's upon their fulfillment as well, if they stay in compliance.
Yeah, well, that's the other thing is if they lose their job, they have to leave the country.
Yeah.
Yeah, the whole,
I just heard about like since I work out in thermal, there's these horse ranches. They bring people from Chile or South America because there's more, I don't know, horse
yeah, that's a
whiskers
different
out
kind of
there.
visa though, but yeah.
Yeah, yeah. And they're only allowed 6 months out of the year to come work. So they work almost 12-hour days and then they go back home with their check and then they wait another 6 months to come back. So I thought, oh wow.
Paid enough, yes. Jacob, are you looking for ways to exploit people?
No, I want to give them a chance to get a feel off for America.
I'm just fascinated.
Let them be tourists. Travel around a little with me.
So back to employee costs. So once you figure out who the employees are going to be, then figure out how many hours they're going to work. So in our case, they're going to do 12 hours a day. So obviously going to have 2 people or more than 2 people. Yeah, because my thought is we would have student workers. So they would be, maybe they would each work 4 hours a day. Each of them worked 4 hours or whatever. So 12 hours a day of cashier time, 4 days a week, because again, like you said, if we have to be open on Friday, Saturday, or Sunday, College of the Desert is going to charge us. And so, and besides which, nobody's going to be there, right? We just have business from the local neighborhood, but there's no classes, there's no staff. So 12 hours a day, 4 days a week. I will explain shortly why I said 51 weeks of the year. But the main reason is even if there's not a lot in the summertime of people there, that's when they could work on marketing stuff. They could do inventory, they could clean the place. So I said $17 an hour because it's above minimum wage. We want above minimum people. Now you could have done this less detailed than me. You could have done it more detailed than me. What I said is there's only 4 weeks in February. And we're only going to be open 3 weeks in December because everybody leaves. And so that's it. And so then for the other 10 months, I took 51 because we're closed for a week, right? So 51 weeks of the year minus February and December. And on the average, it's 4.4 weeks, right? Because there's not exactly 28 days in a month. So my manager cost, I figured the manager is going to be somebody who already works full-time for Sync. And this is going to be part of their job. So I figured it would be 25% of their monthly salary because they'd work 10 hours a week. And the way I figured that out is you need time to onboard people, bring new people in. Here's how the cash register works. Here's who to call if things break. Here's what each of these things cost. It should say here. Here's who to call if you have a question about this. So they need to do some onboarding. They need to stop in and just make sure everything is okay. If they need to do the scheduling. So that, and you need somebody who's permanent because students are going to come and go, right? Because they're going to graduate. So that person, and I'd also have them scheduled on Fridays. They may not come in, but then they might have some questions that people ask or bills, bills to approve or whatever. So that's my manager cost is 10 hours a week. So that's 25% of your salary. And then the thing that people forget, taxes and fringe benefits. So you're paying somebody $17 an hour. You also have to cover their payroll costs, their payroll taxes, their workers' comp, sick leave. So I estimated that based on my past experience of about 15% of the cashier's salary because they're part-time, they don't get health insurance, they probably don't get paid vacation. So about 15%. Now I've worked places it's 10, I've worked places it's 20, but that's an average. For this manager's salary, I estimated the fringe is going to be, the taxes and fringe is going to be 30% because they'll have health insurance probably. They might have vision insurance, might have dental insurance. And again, that's an estimate. Some places, like really big companies, often that fringe will be 50% or more of their salary because they'll have a 401k and they'll have all these other benefits. I've been places where it's somewhat less, like 25, 23%, but that's my estimate. So the other thing you could do, I know at Spirit Lake, when they do grants, they price out every single thing. I mean, it's crazy in detail, like 0.02% for Medicare and 0.13% for workers' comp. So you could be more detailed than me, but I did not do that. All right, so now we're going to do this with Excel. If you are not familiar with Excel, you will be more familiar with Excel by the end of this class. Did any of you take that CIS 10? I think Galen Townsend taught it, computer applications. Oh, well, then this may be newer to you. So what I am going to do is I'm going to compute the number of days in a month, which I already showed you how I did that, but I'll show you in a sec. I'm going to multiply costs by that number through the whole budgeting. I'm going to figure out like how much we're going to sell per day. I'm going to estimate the daily traffic on campus and figure, remember last time we talked about your service available market and your service obtainable market. And I told you about peaches, right? Rhonda has this saying she got from Chris Rock about you could be the tastiest, juiciest peach in the whole world, and there'll still be somebody that hates peaches. So there will be a certain percent of people that will buy juice. There'll be a certain percent of people that buy soda and so on. So I figured estimate that percent and I multiplied that by the traffic. So let's look at this. All right, so here's where I started out. So the manager, I figured this person makes $50,000 a year, $25 an hour, all right? And so I multiplied, so I just created an equation. So 0.25, right, 25%. Can y'all see this here? So to do an equation in Excel, all you need to do is start with an equal sign. So equals, and then in this case, I wanted this done first. I put in parentheses, 0.25.
We should be trying this like as you go. That kind of the idea.
Pardon?
Is this? Are we kind of? I got an idea. This is
Yeah.
If I'm using Google Documents, this is a spreadsheet, right?
Mm-hmm. Yeah, and it should work exactly the same in Google Docs. So I've got 25% times 50,000 divided by 12, because I'm assuming this person gets paid monthly. Now, if you didn't know, now you know, if you click on this little box here at the bottom, you could just drag it all the way across and it'll fill it in I already filled it in, but now you know. Here I got really fancy, but I only had to do it once. So I said 12 hours times $17 an hour times 4 days a week times an average of 4.4 weeks in the month. And so I said that's true for August, September, October, November. So I just dragged it over there. For December, I said we're only going to work 3 weeks in the month. So the same thing, I did 12 times 17 times 4 days times 3 weeks. So that's how I did it for everything. The indirect cost, remember? So this is where I started. I started off saying I thought it was 30% for the manager. So if I do equals 0.3, so equals, and then parentheses 0.3 times the manager, close parentheses plus. Remember all those things from now, or was it 8th grade? Actually, you have an 8th grade and then it comes back again in college algebra, all the stuff about order of operations. So 0.3 times his salary plus 0.15 times their salary. That's it. And the reason I think Excel is the greatest thing ever is because if I go in and change everybody's salary, right, to $18, I could change it here. I could do it all the way across here, and then it just changes everything. So you can change it in one spot, and then
Nice.
everything that's multiplied that, everything that's added into automatically changes.
You just drag it across and it just does it for you, huh?
Yep, it just fills it in. So I've got my indirect costs, 30%, the manager's is 30% of his salary, the cashier's is 15% of their salary. I said rent, we're gonna get for free. Website and hosting, I said the college is gonna comp that. So, and here's the thing, any of these things, if I turn out to be wrong, I can go in and just put in, and they decide to charge us $890 a month. I can just add that in and it automatically changes everything. You know, I'll see my profit and loss this month change, my total loss change, so. And I will put this up on the class website so you can see it, I'm populating. So here's, I'm gonna come back to this cost of goods sold, but marketing, I said, I estimate again, just based on other projects, $300 a month to make flyers or business cards, where we want. In October and November, because we're selling gifts, right? And you sell a lot of gifts around Christmas time. So in October and November, I made this higher. Also in December, but by December 23rd, we're going to shut down. So not as high. Then we're back down to low in January. February is Valentine's Day. So I think you could sell some more gifts. So again, as you're doing this, you're basically putting a number on your assumptions. Then March and April, March, oh, this, I did this, I didn't mean to do this, I meant to do this differently. March and April, it's down. May, I put in some more advertising because it's Mother's Day. A lot of people like to buy things for their mom. And then June and July, I figure we're not going to have a lot of sales, we're not going to have a lot of marketing, but I wanted to keep the store open anyway, because people in the neighborhood, if you close down randomly, they're going to quit coming. And also it's a time for you to train in new employees and take your inventory. So that's where I got that. So all of the one thing that's kind of cool here, this, where did I get this cost of goods sold? You can have something from another sheet that you put into your equation. So this is the really complicated way. It looks really complicated, but you'll see it wasn't as much. So first I said, how many people do I think will come in every day? Well, in August, I don't think too many. There's 60 people on campus. I'm going to say in August, because not every student comes in every day. Some of the students are only online, but there's the people who work there. So they're there every day, and there's students every day. And we have an orientation where students, so I said on the average 60. in September, I said 75 because I think Michelle's going to be out there doing some marketing and more people from the neighborhood will have heard about us. I think there'll be even more because again, the more we get heard about. And then November, December, I think it'll go up because again, people are coming in because it's Christmas. And January, I think it'll be down. We're closed part of the time. So based on these assumptions, February, I thought we'd have some people come in because Valentine's Day. So based on these assumptions, I put how many people I thought would be on campus every day. And then this is the number of days in the month. So we're open just 3 weeks in December. There's 4 weeks in February. And so I multiplied the daily traffic by the number of days, and this is how many people will come through in a month. And if you look at it, I mean, there's a lot of numbers, but basically once I do this once, these equations, like once I do these equations once, then I just drag it all the way across. So I've got number of people per day, number of days, and then the monthly traffic equals number of days times daily traffic. Then I put down all the different things I thought we would sell. And again, this is an assumption. The nice thing about this is you can change this and the whole thing will change and you can see. So I said, here's all the different things we're going to sell. Some juice, soda, baked goods, some snacks, pens, pencils, cards, envelopes, stuff like that. Some little gift items and some large gift items. And then I said, what percent of people do I think that walk through the store or walk by the store in the average day would buy those? And these were my guesses, but I could go online, I could look and see what percent of people drink soda every day. That'd be me. Anything that has caffeine in it, I'm down. So I said, so these are my estimates. 25% of the people that came by would drink soda, 25% would, buy Sierra's fry bread. Another 50% would get snacks because there'll be some people buy 2, some people won't buy any. I thought 5% would maybe get a pen or pencil because people don't buy that stuff every day. And again, 5% might buy some little gift item and another 2% might buy the bigger gift items. Like we're selling some painting for, $100. And I had that the same every day, except for November, December. I figured we'd sell more gifts. February, I figured we'd sell more because of Valentine's Day. So I think 5% of the people would buy little gift items in April, but I think 10% of them would buy something for their mom because, hey, we'll do some really good marketing. And your mom would love this. Your mom would love this beaded necklace. You should buy it for her. Look at all the stuff she put up with from you. Oh, also useful thing, hopefully you can see this. If you click over here on the top left, it will pick everything and say you want it all to be bigger. And so I also so here's how I came up with these numbers. Based on the estimate of what percent of daily traffic will purchase, Christmas season, Valentine's Day, Mother's Day will sell more gifts. So for each item, I've got what percent of the daily traffic, the monthly traffic will buy that. So if we wanted to see, what if we could double the number of people coming in? I could double all these numbers and I could see how my sales went up. All right, so this is how much stuff I said I would sell. Now, how much is it going to cost me? Well, I figure, and again, if we had these actual numbers, we could put them in here. I said 50 cents for a bottle of juice, 50 cents for a bottle of soda, and 50 cents for the baked goods. For the pencils and smaller things, 25 cents. For the gift items, I said $10. And for the larger gift items, $40. So that's what I estimated was the cost of each thing. And then I multiplied the cost of that thing times the number of them. And so it's a lot of numbers, but it's just thinking about how much juice will I sell? Okay, how much will each of those cost me? And then the next question, so this, when I add all these up, this gives me the cost per good sold. I can go to this go here and you can see this just matches up. I can just do equals. This right here. And that's it. And then if I click here and drag that across, it's relative, right? So this says go to the detail page and find row 26, the second column. And so in the next page, it'll go in the next one, it'll go to the third column and the fourth column and so on. So I only have to do this once and drag it all the way across. So now I've got how much everything cost. So those are my total expenses equals sum, right? And then a parenthesis, drag all the things I wanted to sum up. I could put equals this, but this is my total expenses. Is everything from here to here. My total revenue is the same thing. I added up how many I'd sell. So I'm going to sell. I'm going to charge $2 for juice. So I'm going to, what I decided that everything would have a 100% markup on snacks. What, you think that's too high?
No. I have another question. So
Yeah.
like in my store, like I had said in my presentation about having the jewelry like rotated,
Mhm.
how would I just put that in a line, like saying it's native art sold when, or income sold, or how do you say that? It's gonna be on like, what do you call that?
The
Consignment?
cost of goods sold.
Would you just be a line that says consignment and then like an
Oh,
amount?
so you weren't going to pay for, you were going to just have consignment items.
Yeah, yeah. So that's what I would do, is just put a line in there stating it's consignment item.
I think it, yeah, I don't even think it matters that much because you're going to make money on it, right?
Yeah,
So let's say you,
I'm hoping. 'cause it
yeah, so
works.
if they're paying $15 for each of these smaller things,
Right,
and you're paying the person $10, then it doesn't really matter so much if it's on consignment as far as your income statement.
okay, but I mean, I'd still have to put it on my income statement, correct?
Right.
Okay.
Because you got $15 for it and you paid them 10, or in this case, you got $60 for it and you paid them 40.
Right,
So
Okay.
you still get revenue and you still have to pay them.
okay, just making sure.
So with my revenue, I decided, and again, we talked about ethics too, and the decisions that you make. I think that the people who are making the jewelry and the arts and crafts, they should get a bigger cut than somebody who's making Cheetos. That's just my personal opinion. So I put that in here. So these people, for all these snacks and things, we're selling it at double the cost. So we're making 100% profit margin. With these people, we're making a 50% profit margin because we're giving more of the money to the people that made it. So that's, and again, so you can actually quantify the decisions that you make. So again, these people, I said, we're paying them 1.5 times the cost. These people, pens and pencils and stuff like that are pretty small items. So we're actually marking them up more. We're charging 3 times the cost for those. And snacks, we're charging double the cost for all those things. So for each of these, I just put in how much markup I'm going to get. I'm going to charge twice as much as I paid for it. And same thing, to get my revenue, I do the exact same thing. That it equals the sum.
Are we supposed to be coming up with like actual prices or just like guesstimate prices?
For this, you could do guesstimates. If you're doing really, when we're really doing a business, we will go in and actually see how good of a deal we can negotiate.
Okay,
And, the other thing too is maybe I'll ask some people, who do I know that runs a store? That's a good question. Yeah, I'll ask some people like, how much do you pay? So now that I've got the revenue, I can go back and there's my revenue. It equals equals. Anytime you put an equal, the Excel is expecting a formula. Now the formula could be just as simple as, it equals this. So what you'll see here is now I went through all of this and I found out that we're losing money every month except November, December, February, and February. And then if I want to see how much total did we lose, I could do again, equals sum, and then drag over. You could also, if you just want to type it in, just do B11 and then a colon to M11 and see how it highlights the ones it's summing up. So it says my first year I'm going to lose $27,856. And so I thought, well, maybe I'll make money the second year. But it's not that uncommon that something loses money its first year. So I went through this whole kind of process again. I assumed that we would have, I just copied everything over and changed some numbers. So I assumed the second year we'd have more people starting out because they know who we are. We'd have more people every month. And all the equations were the same, but pretty much all I did was change the daily traffic. I did not give everybody a raise because we are still already losing money. And so it came out to the second year, we would have, we'd lose $8,700.
So when your trend starts doing that, is that like for, like I keep saying, for a store? Well, because we all got a store or something. But do you start going in and looking at your product and say, oh, okay, maybe we should just do a sale on buy 5 pencils for whatever,
Right.
$2 instead of 99 cents each. You know what I mean? Like
Mhm.
just to get the inventory out. Is that what we're going for?
Or we could look at this and say, all right, this is the second year we're losing a few $1,000s. What if we could increase the traffic by 25%? So instead of 100 people, we had 125. Let's see if we just went through and increased this a little bit. I mean, not a lot, but just a little bit. What difference would that make? I'm just going to go in and increase this about 15% every, so it's not precise, but let's say an average of 15% if we could increase the traffic coming in. Would that make a difference? So I increased the number of people coming in by 15%. And lo and behold, if we could do that in our second year, instead of losing money, we'd break even. In fact, we'd even make a couple $1,000s. So
Nice.
does that mean like people need to get on their marketing and,
that's right, Michelle, get on it.
That's right. Guys, no, I'm just kidding.
It does take a little bit, but once you get to working with it, it doesn't take that much with Excel. And the nice thing is you can go in and change these numbers and see how it changes everything in your equation. I always try to bring in more revenue than cut cost. I always think that's a better strategy. But let's say instead, if we wanted to, and we could, instead of making this like $17, we could have another column that's salary. But let's just say we decide to go in here and change everybody from $12 an hour to $15 an hour. I changed it to 15, I did, okay. And you can see it's not changing. If you look down here, changing that salary isn't changing how much I lose very much. And so that's another reason to look at it. I personally, like I said, I don't like the idea of trying to cut people's salaries to cut your cost. And you can see it really doesn't that much unless you have some people who are just making a lot of money or a ton of employees. So that's how I would figure out how much we were losing or making every month. That's how I would kind of mess around with different assumptions and see how much money we could make if we had more people, if we had fewer people, if we charged more for each thing. But then you've got to keep in mind too, if you charge more, remember the whole thing about price, you can't just double the prices and figure you'll sell just as many, because that's probably not going to happen. So that's how I would start and figure how much money I would make or lose.
Is this just a regular spreadsheet template?
Yep. Well, it's
Okay.
not a template. I made it up.
Well, I mean, like, you know, the selection you get to choose from. but-
Yeah, it's just a regular spreadsheet, whether you use Excel or Sheets.
And then
Um,
just your formula of what you
Yeah.
expected number of days, pay.
Right.
Yeah.
So you would start with, who are the people that you're going to have working? What is the indirect cost? Now, I call it indirect because it's a habit from grants. Grants have a different meaning for indirect cost. But that's, yeah, so you would start with who are you going to hire? How many hours are they going to work? What is the tax and fringe? And then most people would have rent, though if you have a home office, maybe not. Maybe you don't have any more rent if you're working out of your house. And then just put in everything that's going to be an expense. And like I said, the cost of goods sold, you could estimate it to start out if you are just selling a few items. Maybe if you have a side business and you're working 4 hours a night or 20 hours a week, and you know that your cost of the items that go into your stuff, like say if you're talking about a food truck and Sierra's talking about fry bread, you might know about how much it costs you if you're working 1 day a week, and you can just multiply it by 5.
Well,
But
I figured it's by the volume until you sell out.
Right.
Like, you're done for the day then.
Right.
Then you're on free time. At any given location.
So that's how I would estimate all that. Any questions on that before I dive into more financial stuff?
It looks really good, by the way. I really like the way it's set up, and it's a really good idea. Looks fun, actually.
Well,
To
and
kind of play around with.
yeah.
Oh, it doesn't. No, I'm just kidding.
Well, I like how it lets you test if somebody says, hey, we would make, we'd make money if we got in twice as many people. Well, and then sometimes people come up with really crazy assumptions. What if we got 1,000 people a day coming in? Well, where are you going to get those 1,000 people? So when somebody tells me, oh, I'm going to, and this is a thing that investors ask. If you say we're going to make, $50,000, well, where are you going to get that 50,000? And it doesn't have to be this detailed, but you do need some level of detail, not, oh, if I can sell 250 pizzas, because if you don't have the business going yet, you need to convince them that you have some idea of what you're doing.
So you put that maybe booth at Powwow in the marketing line.
Oh, that was just my idea that, so where are we spending this marketing money? So for the first,
Okay.
we're going to do flyers and business cards, but what are we going to do extra? Maybe we'll have a booth at a powwow. Will we, have some free samples or flyers, or I don't know where the extra marketing money would go.
Maybe college events.
Yeah, like when there's a student orientation, faculty orientation, or anything COD's doing, go over and say, hey, did you know there's another campus? You want to start with projected income for IMSM statement for 2 reasons. One is to show how much money you need to get started. but also to check your assumptions. And I like to do it for 12 months like this, because honestly, when people, I mean, people do, I mean, they ask for 3 and 5 year business statements. But the truth is, and I think any investor ought to know this, I mean, after the 4th year, you're just guessing, right? I mean, this is a brand new business. We've never done it. How much money is it going to make in 5 years? I don't know. But if I have this document set up, we do this in our company, we can track how much money we thought we would be making each month and each quarter and each year. And we are very proud to say we have hit our projections almost every year. But if you're not coming close to that, then you go back and see, well, where's the problem there? Are you selling way less than you thought? Are things costing way more than you thought? Sometimes we have found that our staff costs are way more than we'd anticipated. Or we had brought in these extra marketing people and we thought that would translate into extra sales, but it didn't happen. You know, and sometimes it's not their fault. I mean, we had one guy who I think could sell anything to anybody. And unfortunately for him, we hired him as the pandemic started. I mean, just nobody was buying anything. Just there was a few, our sales eventually went way up because software where kids can learn at home and software where kids can learn indigenous languages and all that. You know, once things started opening up again, things went better. But at first, everybody was just running around like, I don't know. Nobody taught me I was going to teach 6th grade to kids online. What? So it may be not that your marketing people suck, but that the market has really changed. But having that projected income statement lets you take a look at it every month and see how you're doing. And one thing a dear friend of mine always says is that too many people confuse wishes with plans. So here is our detailed plan, and we can look and see how we're doing every month compared to that. But the other thing too is it keeps you from panicking, right? If I said we're going to lose money every month up until November, and we are losing about the amount of money I said, and it's October, we're not going to quite freak out. So we're going to get into financing. Now we have looked at what do we need? We need about $50,000 from my computations to start this company, start this store and keep it functioning for 2 years. And I don't think $50,000 is a reasonable amount to ask because it will provide a service in the community. It will provide a market for those individuals that are selling baked goods, that are selling food. It will provide a market for people who are selling jewelry and other, other traditional gifts. And it will provide an opportunity for our students to get real hands-on experience. So you see, I'm getting my pitch ready, right? I'm serious. So $50,000 total to get it up and running and run it for 2 years before it breaks even. Now that would be a seed stage company, right? We're not only not yet generating revenue, we don't even exist. And the idea is that when you start out in at a seed stage, that you're going to generate revenue through savings and from friends and family. And that makes sense from a certain point of view. I was in an accelerator and I was talking to this banker and I was a little bit irritated because I felt like a lot of these investors and lenders didn't want to lend money to people until they had pretty much exhausted their own savings. And I think I told you before, at one point we owed $87,000 before 7th Generation Games started really making money and we could pay ourselves back. And what this banker said is, why should I take a risk if you aren't willing to bet on yourself? He said, what I want to see is that you, founder person, have some skin in the game. Because he said, I have this happen to me all the time. I have these young people, not picking on Sarah, but but he said, I have these young people come to me and they want me to invest $300,000 or give them a loan for, $100,000 for their business, but they haven't put anything in it themselves. And he said, if you're not willing to take a risk on yourself, why should I take a risk on you? I want to see that it will be painful for you if you fail. I want to see that you have maxed out your credit cards, you've gone to everybody you know, and at that point, come to me and I'll say, oh, well, this person must really believe in this. They've invested everything of their own. Now, I will be honest, I did not invest everything on my own, and I don't necessarily recommend that unless you're super young, because if you're 25, you have the whole rest of your life to go out and, make more money and save more money. But I do get his point. You should not expect that all of the money to start that up is going to come from investors or is going to come from banks. You should expect that some of it is going to have to come from you, whether it's you working for free, whether it's you investing your own savings, whether it's you, racking up the balance on your credit card. If you really believe in it, you're going to have to put some of your own risk there. So since we're going to segue into finance now, so we've talked about accounting, which is tracking where the money's coming and going. And next we're going to go say, all right, now we have all these financial statements. I'm going to get to some more at the end, but we have these financial statements, and now we're going to come back and say, give us money. So let's take a break for the next 10 minutes. Let's come back at 7:40, and then, then we will talk about financing and having people give us money. Okay.
Actually, I have a question. When you're talking about doing through a bank, wouldn't you just get that, like the other students, wouldn't they just go in and get a personal loan?
Well,
They don't need to know the rundown of what you're trying to do.
well, first of all, not everybody has the income to go and get a $300,000 personal loan. So yes, you could do that.
Right.
And I totally did that.
Right. I mean, just giving them ideas, I guess.
Yes, you can, and I did.
Right. Okay. Just making sure.
We will start back up talking about financing. So as I said at the beginning, accounting is tracking how the money is coming in and going out. Financing is getting other people to give you money so that you can start your business and keep operating. Is that icon for you, Bob the Builder, Andre? Because that's pretty cool.
You see him, huh?
Kind of looks like Bob the Builder from, I don't know, Disney Plus or whatever. My grandson loves it.
You see him, Bob the Builder here. Yeah.
Cool. Now,
Yes.
I was online on Twitter, in fact, and this investor made the comment that the first 300,000 should come from friends and family when you're financing. The first 300,000 year round. And this founder, who happens to be African-American, said, dude, I don't know what kind of family you think I've got. And the fact is, there's very different, there's a great discrepancy in founders, and 98% of venture capital funds go to men. I think it's something like 0.1% goes to Latina founders. I presume for Native Americans, it's equally low. And one reason you don't see a huge amount of friends and family money coming in to certain groups is because their families don't necessarily have that kind of money. I know mine sure didn't. And then there's people who maybe your family does have that kind of money, but you don't get along with them because they're toxic. So the idea behind the friends and family round is that these are the people who know you best. So it's kind of like an extension of if you're not willing to invest your own money, why should I invest my money? If you can't convince the people closest to you who know you the best to give you money, then why should I, angel investor or bank who doesn't know you, help you out? So that's the idea behind it, but it just makes an inequitable situation of having access to capital even more inequitable. So that's not a good thing. Still, it's not a bad idea to ask everyone you know to invest, because some people may surprise you. There were people we're doing a crowd equity round right now, and there were people who invested that I would not have thought had that amount of money based on what I knew they did for a job, right? Like they worked for some nonprofit and I know they didn't make very much money, but just so happened that their parents had literally sold the farm and they had inherited a lot. And so they invested. So one thing is you just may not know. And then there were people who I had never heard of who invested in our company and sent a message saying, my niece told me all about you. So their niece is a kindergarten teacher or something. And she said, yeah, I didn't have any money, but I thought your thing was a great idea. And I told my aunt who's rich. So telling everybody you know and getting your friends and family to try to invest is a good idea. There is this stereotype that companies are founded by young people, but in fact, I found when we are doing our crowd equity round, far more the people who invested $1,000, $2,000, $10,000 were people I knew. Because the fact is, as you're older, you're more likely to have friends who fit into that angel investor category. So this takes us to angel investors. And angels are people who invest early. They're taking the biggest risk. They're usually not people who invest in companies for a living. They're called angels because I guess like some angel that come in and help you out. To be an angel investor, for you to go in and try to get somebody to invest in your startup that's not friends or family, they have to be accredited. And that means they have to have a net worth of more than $1 million. Or they need to, and I think it's over 200,000, but they need to either have a net worth of over $1 million, or they need to have above a certain income, and that income is expected to continue. So like if they're a cardiologist and they're making 500,000 a year, they would be considered an accredited investor. So where do you find those angel investors? Well, you could find them, again, be referred by your friends or family. There are groups that you can pitch, and most of them will just let you email them. If you go to Tech Coast Angels online and say that there's a form you could fill out for a lot of those angel investor groups, and they will just let you come in and pitch. They get hundreds of pitches a year. Now, usually you'd fill out something similar to what you did for your, what you're doing for your pitch for this class. It'd just be some questions on what your business model is, what your competitors are. You fill out that form, and if they think that's good enough, they'll invite you to come in and pitch. Sometimes they have online pitches where you could just sign up. So angel groups are one place. LinkedIn, you can go to LinkedIn and just find people who are angel investors. And I think I might have mentioned one of our investors we found on LinkedIn, or he found us. He said, I saw your company, I'm interested in talking to you. There's also things like Angel List, which is a website you can go in and put your company on. There's no cost to it. So that's one place. From angel groups, from websites like Angel List, from LinkedIn, and from referrals. So angel investors are most likely to invest at the seed stage. They're putting in anywhere from $10,000 to $40,000, $50,000. Now, I wanted to mention this about early stage because your textbook talks about venture capitalists investing in early stage. And I think their early stage is different from what I would think and what most of you might think of as an early stage. Like you might think of the first 2 years of our company, our Sync stores, being early stage. When a venture capitalist is talking about that, they're usually looking for something like $300,000 to $3 million annual revenue. So if we got to a point where, say, our Sync stores make $150,000 a year profit, and we have a viable example, a viable concern, I think, oh, that's even past early stage. We're profitable. But no, they're talking about $1 million in revenue, maybe I've had venture capitalists say they were looking for up to $5 million a year. And my thought, frankly, is, buddy, if I was making $5 million a year, I would not be looking for money from you. But that's the way it is. So I guess it's early stage compared to, say, Google right now. Then there's the mature stage. When you're at the mature stage, mature companies are making money. And so in that case, right before the break, Michelle was talking about bank loans. Traditional bank loans at that point are a possibility because you can go and say, I'm making $300,000 a year. I want to take out a loan for $500,000 to build another company or open another site. When you're at the mature stage, like a mature human, your mature company is not growing a lot, right? Unlike a mature human, you can actually sell a mature company or take a loan against it. So this is also the point where you've kind of figured it out. This is how we get customers. This is how we make money. We're way past the break-even point. This is where you might decide to sell a company. And there are brokers that, just like there's real estate brokers, there are brokers that handle people who want to buy companies and people who want to sell them. Or you could decide to go out and start all over again in the entrepreneurial phase, like we did. And I think I'll go open a company in Chile. I'll take the same model and open it there. Now, when you get to the mature stage, debt equity is more of an option. And like Michelle said, you can go out and get a personal loan at any time if you have the credit, right? If you have good credit score, maybe you could just get them to loan you money. And I did that. I did everything you could think of when we started the 7th Generation Games and even when I started the Joy Group, which started breaking even fairly early on, but it goes back to what I was saying about the difference between revenue and cash flow. Some tribes, who will remain nameless, paid really late. I mean, they did pay, but they paid really late. And part of it was maybe they had high turnover in the finance office or for whatever reason. So I would be flying to places, but paying for the plane tickets, paying for my hotel room, maybe paying an assistant, paying for a rental car, and then I wouldn't get paid for months. Now, after the first couple of years, the people who were paying me 2 months late from 2 months ago are covering the cost of the people who are an answer to the question of, are there any small business grants we can apply for? Yes, and we will get to that. So if you get a loan, the disadvantage of it is you have to make regular payments, right? So I could go to SBA will underwrite loans, but if it's over $25,000, you have to give them collateral. So your car or your house, and if your business fails and you don't pay the loan, they can take your house. The downside of getting debt financing is that you have to make regular payments on it. Now, with equity financing, whether it's angel investors or venture capitalists, you have to give up a stake in your company, but you don't have to pay that person back until you either sell the company or you do an IPO. Advantage of taking out debt, you don't have to give up any share of your company. You still own it 100%. But the disadvantage is you have to start making payments now. The equity financing, you have to give up a share of your company. And my advice on equity financing is don't take it any sooner than you need it. Because the earlier stage it is, the less money you're going to get for an equal share, right? If it's just an idea or you've got very little done on it, the first equity financing we got, we gave them 7% of the company for $100,000. Now, there's no way we would give up 7% of the company for $100,000 now, because we're much further along the line. But at the time when we were getting started, it was really worth it to us. So it's up to you to decide how important it is you to maintain ownership. I would say maintain as much ownership you can, as long as you can. That's why you're founding a company instead of working for somebody else. Now, I said before, one of my goals is that when you leave this class and tell anybody you got a degree from SYNC, they don't laugh at you when you make mistakes, right? that you will know the things they expect somebody who's had a class in entrepreneurship to know. So if you hear somebody talk about an IPO, what they mean, an IPO is an initial public offering. You probably won't be doing one for a very long time. And I'm not saying you won't do one, but it takes a long time to get to that point, because an IPO is when the company is sold on the public stock exchange for the first time. So initially, and very few companies make that point. They're either making millions of dollars, or they have millions of customers that investors believe can be turned into millions of dollars. So at the point of an IPO, you would be making a lot of money. Most people, I think it's far more likely that they would end up at the point where they're making a profit and have a lifestyle business and keep going, or they're fairly successful making money and they sell the business. But an IPO would be like winning the lottery. But people do. All right, so we talked about financing a little bit. We talked about your income statement and break even. The other financial statement that investors or banks, anybody giving you money is going to want to take a look at your finances. They're not just going to say, oh, hey, you're super smart, let me give you some money. I think I'm smart, but if you go and check out our crowd equity round, not only, it doesn't just say Anne Marie is smart, Marie is smart too, and so is Dennis, give them money. There's a whole bunch of financial statements in there that we were required by the Security and Exchange Commission to have. So so you need cash flow analysis, you need your income statement, and the balance sheet, which has to balance. Not surprisingly, it's in the name, right? So your assets equals liabilities plus equity. So we're going to go through several examples here. So here my assets is, an asset is anything you have that's worth money. It's actual, in this case, cash, actually money, or things that are worth money. So any ingredients, furniture, restaurant equipment. So you add up all of the things that you have that are worth money, and that is your total, your total assets. And then liabilities are the things that cost you money. So accounts payable are bills that are due that you haven't paid yet. So you bought all these ingredients, they sent them over and they sent you a bill and you haven't paid it yet. They put credit card payable, or if you had a loan, that would be in your liabilities. And so so this is the total asset, the total stuff you have that's worth money, your total assets, the total money you owe. And then if there's any difference between that, that's the equity in your company. You've got 27,000 in assets, more or less, and about 5,600 in liabilities. So the owner's capital is $21,000. So the accounting equation is pretty simple. It's just that your assets equals your liabilities plus equity. And we're going to go through some nice examples from the textbook. I put in $1,000 in cash, and then I took out $1,000 of that to buy a computer, right? So now I have $1,000 left. And then I put in another $5,000. So I have $6,000 in total assets. I have $5,000 in cash and I have a computer worth $1,000. I have $0 in liabilities. I owe nothing. My equity is $6,000. It's the $1,000 that I had originally put in that went into this computer. And then I made $5,000 in revenue. And so all of that is mine, all mine. So if you just put, when the very beginning of your company, maybe you just put in money. So you just have the assets is the money you put in, and your equity is that money. And there's no liabilities, there's no revenue. That's where you're going to start. So this is kind of backwards. So then you buy the computer and you have $0 in cash, but you have a computer. So you still have $1,000 in equity, just now it's in the form of a computer instead of cash. So anytime you add in cash, your equity is going to go up, right? Other things being equal. So we talked at great length about financial statements, greatly more length about your income statement than your balance sheet, because I think when you're starting out, your income statement, projected income, tracking your income, your cash flow is going to be much more important. Your equity is going to be pretty much what you put in it, and hopefully you won't lose that money. So let's talk, and we talked about getting funding from friends and family and getting funding from investors, but what other ways could you get funding? So there are a few, and one of them, we're going to go through each of them a little bit. There's bootstrapping, there's bartering, there's competitions, pre-orders, and crowdfunding. Competitions, you can make money that way. I mean, there aren't a lot of them. We just actually won, well, we've won a couple. We just won one where we got $5,000. I mean, it's not a lot, but it was $5,000. We won Best Entertainment and Education Startup at the Global Entrepreneurship Summit. And we got, I think, $5,000 plus a computer plus $100,000 in Amazon Web Services credits, which was really helpful because we use those. So you can, but usually there aren't, you can't really run your business on competitions, right? It helps a little bit. Bartering, I was really interested to see that some of you in your business plans included bartering because I hadn't thought of that. But sure, that's an option. And one place that I do see it is in food and beverage organizations like Anheuser-Busch or some of these different food companies. They will give product to stores or restaurants in exchange for marketing. So they want you to put their cereals in the best spot in your store. And if you agree to do that, they will give you an extra 20% of that product for free. Or they would like you to put up pictures of their, those pop-up stands. I'm sure you've seen them, like if they have a mascot that's Tony the Tiger and they'll have a life-size Tony the Tiger, stuff like that. So sometimes you'll get companies that will agree to do that in exchange for some kind of marketing. So bartering is not out of the question. It was just something I hadn't thought of. So I thought that was interesting. Some of you had it in your business plan. Pre-orders are another one where if you're making fry bread, if you're making tamales, you can have people order in advance and pay you. And then you can go out and buy the material and deliver their orders. So some catering companies can manage that. Others, people are a little reluctant to give you money up front. But pre-orders are one way, and pre-orders are basically what crowd